Today, we're going to outline long-term views that our business is talking to our clients. One of them is old world businesses, which actually dominate indices, so these are largely value stocks in the past, will actually struggle in the next 10 to 20 years, and there are some substantial headwinds. So I'll start with that point. And the second point I'm going to make is long-term investment in quality businesses exposed to structural tailwinds will steer you safely through these turbulent times. So what do I actually mean by that? So let's talk about some of the tailwinds that have been around for the last 30 or 40 years that have contributed to this fantastic market we've had over that period where a lot of people have got wealthy. So let's start with the adoption of technology. Now you can see there the acceptance of the automobile took a long time, that's the red line, and compare that, for example, with a number of these latest technological advancements, and whether it's the microcomputer, the mobile phone, the whatever, real contributors to technology. Look at the speed with which they've taken up. So that gave GDP a nice push. It's only a part, but it's one part. The second part is population growth. This is not a secret. Everybody knows about this. That's the baby boom back there. Women were much more productive in terms of children back in those days, and a lot of those children came into the workforce in the 80s and 90s and were very productive over that period, and that gave that a boost. But here we are back at 2.49, that's across the world, and that is actually skewed by places like Africa where the fertility rates are up around 5, and places like Australia where it's under 2. So in Western economies there's been a substantial drop-off in fertility. Let's also add to that the boost that came from women who had their children moving into the workforce. Look at some of the lifts over that period of representation of women in the workforce. So not only did we have more in the population, we actually had women who weren't previously in the workforce adding to the overall productivity. No wonder it was a great period. We capitalised on that by bringing forward a lot of the growth by using debt. So what that's saying there is back, I did this in 7-year periods just to give you a feel. 2000, $87 trillion US worth of global debt. 2007, $142 trillion of debt. And you would have thought that when the GFC came along, everybody went, oh no, we have to stop now. No, but we didn't. We've added another $57 trillion worth of debt just to 2014. At some point in the next 10 to 20 years, we're going to have to stop. Like, there's just a limit. I don't know where it is. We're not trying to predict whether it's this year, 10 years or 20 years, but at some point there's got to be a deleveraging, and that will have a negative effect on growth. This interest rate drop that came from the US recession in 1982 led to a long-term re-rate of companies and markets. It's down where it is now, and it's, you know, the best we can hope for is sideways. It does mean that in the future, real re-rating has got to occur on the basis of earnings and dividends. That is, growth in underlying corporate values is going to come from real earnings and real dividends, and not just a re-rating. That is, not GDP growth that allows an average company to lift its sales a bit because the rest of the economy is lifting, with some operational leverage actually producing some earnings growth. That's just not going to happen if this continues to go sideways. Now, what is interesting is the wealth have grown really wealthy over that period. So this is just the US. I couldn't get the number from, you know, and it would be too much manipulation. So I just worked with the US. But that's the number of people between 2009 and 2017 with more than $1 million in financial assets, 3.12 million to 5.66 million. That's an interesting statistic, but here's the next part that I think is much more interesting, and from a statistical point of view, is that the wealth of the top 0.1% now equals the wealth of the bottom 90%. I might just let that sink in. The last time that happened was back here. So this is back in the 20s. Here we are here. So there's this here. So this essentially is a form of hollowing out of the middle class. So this is the effect of low wage increases over the last 10 to 20 years for the middle class, outsourcing, offshoring, automation, gig economy. All of those things have created a situation where that middle class has compressed. These people now, in the US particularly, are taking 2 jobs to keep their heads above water. They're time poor and they are value for money seekers because they're not wealthy like they used to be. The middle class, I'm going to ignore the political implications of this. We could have a 2-hour discussion. this is potentially a let them eat cake moment, and like social unrest. This is Trump, this is Brexit, this is all of this sort of stuff. When a whole portion of the economy, which used to be sort of the down the middle voters, start feeling disenfranchised. This growth effect here, depending on who you listen to, is a combination of increasing wages for the wealthy and cheap money and growth in underlying asset values. It has real implications for investment, long-term investment, and I'll get to that later. So I'll just put a ring around it at the moment, talking about the really wealthy, the top 0.1, and the consumer class, who are now very focused on value for money and convenience because they're time poor. Populations are getting older. This is sort of the other end of the baby boom. This is a fairly substantial part of the world population, obviously Japan in extremis, but these people are getting older. Their most productive days are past, although obviously with some grey hair I still think I'm pretty productive. But as you get closer to retirement, you obviously don't produce the same GDP per capita as you did when you were in your 40s. And that has serious implications for GDP growth as well. And finally, the global economy is powered unsustainably by burning fossil fuels. So, at the end of the day, you either take the Trump view of it and, this is all rubbish, or in fact, the reality is that over the next 20 years, there are simply billions of dollars worth of infrastructure that rely on fossil fuels that will be worth exactly zero. Because in the next 20 years, it's very likely that the marginal cost of renewable energy will be pretty close to zero. So that just changes the whole world. And there were some very strong tailwinds, but these have all turned into headwinds. And so what I'm talking about here is what I said earlier. There are a bunch of companies. The most common question when we're out talking in the market is, so you've had a great 10 years, Hyperion, as growth managers. When does it mean revert? When do the value managers get their opportunity? Well, the reality is what we're looking at here is a whole new world where all of those tailwinds that pushed those stocks, those old world stocks, for many, many years, allowed them to get little increases every year in their sales. If you want to think about those, think of the Australian retailers. Just every year try and make Christmas better than the last Christmas. That's how they got a bit of operational leverage, and then they got their earnings growth. Well, that's just not going to happen in the same way in the future. And there are all of these things that are headwinds. But there are tailwinds, and they still exist. They don't exist as much in Australia. That's why the global opportunity is there. Global companies generally have larger addressable markets, which is important if you're looking for growth. They are higher quality businesses compared to Australian businesses. They have lower levels of debt, higher access to quality staff. So what I'm going to do is actually go through some of the companies we own in the portfolio, not every one, but can I just start with this statement? This is not a securities recommendation. The reason I say that is that repeatedly over the last 5 or 6 years when I've been out talking to people, I often get the comment in a meeting, hey, I went and bought Ferrari on the back of you talking about Ferrari. And my heart sinks when that happens because it happened about a year ago. I gave a presentation and I talked about Starbucks. And the story goes that I spent 2 weeks in the States with Jason Orthman, our deputy CIO, and we visited 10 cities in 10 days. And he forced me, as the only coffee drinker of the two, to drink a hell of a lot of Starbucks coffee. And I said at the end of it, look, I have drunk it before. They're burning it. It's too hot. They don't look like coffee shops anymore. They're turned into lunchtime restaurants. And Jason said, yes. And the thing that drives people back to Starbucks is their loyalty program. And at not one of the shops that we talked to did we find somebody behind the counter who could point me to how to sign up. Failure of execution. And here we had it in the portfolio and looking at years of growth in China rolling out 30,000 stores. Now, that's just an anathema. So the team came back and sold it the next day. Unfortunately, I can't ring everybody I've talked to in the last couple of months and tell them we've sold Starbucks. So I just start that point here because I actually am going to go into some detail here. So here are the interesting tailwinds. Now, these are not unusual stories. You've seen all these names before. Lots of people hold them. what's different about Hyperion is we're prepared to hold them at up to sort of 13% of the portfolio. And I'm just going to go through a couple of them. I'll happily take questions on any of them in Q&A at the end. But I just point out, this is the tailwind that I come from, where there's all these people wanting value for money services, and these businesses are all about developing excellent customer value propositions. That is, they're spending more money than just about anybody else in really delighting their customers. Now, clearly, one of the companies that's doing that best is Amazon. And I was reminded how current that is when yesterday I read in the papers that Woolworths, Coles and Metcash are spending $8 billion on refreshing their stores and DCs. And go to Amazon's last fourth quarter reporting. There are 4 pages of close typed point text of initiatives they're working on to delight the customer. And at no stage do they say anything like, we're going to make the stores look prettier. It's all about saying, okay, so we took over Whole Foods. So now what you're going to be able to do is go online, and you're going to be in 80 cities around America, you're going to be able to come and pick up that order within half an hour or have it home delivered within an hour. That's the sort of thing I'm looking for when I'm a customer, when I'm time poor and value for money. I want it cheap and I want it convenient. I don't need a pretty store. And if I go through each of these in their own way, they're thinking about this sort of stuff. So Wayfair, for example, not a lot of people, many people have heard about it. It is a business that allows you to take a picture of your empty lounge room and then load that up to the website and actually look at the items that you're buying in situ and hold the phone and turn it around and get a 3D, it's augmented reality. Now that's clever because they've got tens of thousands of sofas. They don't carry them themselves, so they're capital light. But compare that to going out to Harvey Norman to see the 30 sofas that you can buy on a good day out there, or these all deliverable in 2 days. And their major metric that they measure is not time to delivery, but the quality of the delivery, that is the least amount of damage, because that's what you're interested in. If you get a sofa, whether you get it on day 2 or day 3 doesn't make a difference, but if it turns up damaged, that's a problem. And that's why we think this is a fabulous business for the long term. Facebook I could talk to until I'm blue in the face, and I won't today because I've got some statistics later. Alphabet is the same sort of thing, but the reason we own businesses like this is not only for their current business, which we think is amazing, these new world businesses, and by the way, new world, what does that really mean? These businesses have been around a long time. Are we still waiting for their business models to fail? Like Amazon, 1994, PayPal, 1998, Facebook, 2004, often more than 20 years. I mean, they're not new world businesses anymore. They are the businesses of today. Cash to card is still got a long way to go. Now, I'm always wary about asking this question and asking for hands up, but the statistics are that the penetration of cards into Australia is over 90%. So who here now pays for a coffee with their card? Who would slap a... Oh, wow, okay. Who would have done it? Remember 10 years ago when you had to put your card into a machine and sign a chit? Who would have paid for a coffee 10 years ago by putting their card into a machine and signing a chit for $3.50? Well, the reality is nobody, because virtually no coffee shops would take it. But the coffee shop in the Met Centre down there says basically everybody taps a card these days. So Australians, as usual, are early adopters. But let me tell you, it's very easy to feel that that's how the rest of the world works. I'm off to Japan on Saturday, and I'm telling you, you've got to take a lot of cash to Japan because they don't use cards the way that we do. And in America, even though tap and go is starting to come to the fore, most places in America will still ask you to put a card into a machine and sign a chit. There's still $17 trillion US dollars of cash and checks being used for commerce around the world at the moment. The major winners out of this long-term tailwind are Visa and MasterCard. I'll cut to PayPal in a second. But I'm not even covering the potential $30 trillion market, which is the B2B card market. And that hasn't been monetized. So there's 20 years of growth there in those sort of businesses. And I know a lot of the market is talking about this year and the next year, but I'm talking about the real long-term opportunity to add substantial value to the capital growth of your clients' portfolios. PayPal is another amazing story. As I said, it's barely 20 years old, 300 million customers. I gave this sort of speech this time last year, I think it was. They had 90 million customers back then who had, on their mobile phone, had indicated one-touch payment. So they were easily able to buy something without putting their card details in. They just tap buy and it goes through. Today it's 123 million out of 300 million customers. So they've really taken over. If you think about it, the benefit to the customer value proposition is so substantial, it's hard to believe somebody else could come in and improve on that. And for the merchants, they're picking it because it reduces the cart abandonment, which is a real problem in online shopping. People get to the last point, they've got to get their card out. They think, oh, well, I give somebody my credit card, I've had it cancelled once in the last year, I don't want it to happen again. So I want you to think about all of these and the propensity for very long-term growth out of them. Clever tech. So who here still uses Microsoft? Who's still using Excel, PowerPoint, Word? Yes, well, just about everybody. I mean, is there anything else? I mean, yes, there is. But the reality is, so Microsoft are really, managing to dominate the cloud component of that with Azure. They're growing their business, that part of the business, at in excess of 45-50% per annum. So are AWS, so are Google, by the way, with their similar businesses. But they've got that part wrapped up because Office 365 actually is pretty good. And for those who've gone the old way, when they switch over, as Pinnacle did and Hyperion did in the last year, it's been a revolution in being able to travel freely and have all of your information available. That's where this really goes in the future. I mean, this is potentially $1 trillion addressable market, and it's only in its early days. I mean, Amazon only started splitting out AWS a couple of years ago. Currently, revenues of $24 billion, growing at 45% per annum. Have you ever heard those sort of numbers in Australia? Not common, is it? No. I'm not going to go through all of these because I am on a bit of a time limit, but I did want to talk about ultra luxury and exclusivity and membership, and loyalty businesses, because that 0.1% is an important part of the market. So I gave this presentation in Brisbane, and I just want to see whether. So I ask anybody in the audience who has a Hermes handbag, a Birkin bag, a Constance bag, a Kelly bag, or a Ferrari. There weren't any hands, and somebody said, "Mate, this is Brisbane," as if. But the reality is the waiting list for these products is substantial. I mean, it is hard to believe, and we travel widely, and I think most people here would think they're globally minded. It is hard to believe that somebody would pay 150,000 euros for a leather bag. It's also hard to believe that they would buy it and then immediately resell it on eBay for more than they bought it as a second-hand product. But that is exclusivity. These are almost considered by the ultra-wealthy to be investments. And Ferraris are similar. They're at that level. So the point I'm making here is that while this is not a huge part of our portfolio, and the growth in it is not nearly as high as some of those earlier stocks I was talking about, they're very resilient. They're very resilient to the GFC. Ferrari's order book dropped 4% compared to most other luxury car makers of 40%. And Hermes went quite well through the corruption crackdown in China a couple of years ago by actually increasing their numbers in a period where everybody said, oh, but China, if China cracks down, they're really going to struggle. Most of that occurs with the aspirational luxury brands, not these exclusive luxury brands. And I do want to mention Costco because while it's not big here in Australia, the opportunity for these loyalty programs are pretty substantial. We did a trip down from Brisbane to the Gold Coast the other day, and we were sitting in the back talking about stocks, and it was an Uber driver said, oh, mate, I just use Costco all the time. I said, oh, why? He said, the petrol. He said, I go to Costco to fill up, and I go inside and I buy all of our stuff and put it in the boot, and I drive around all day with all the passengers and I take the stuff home in the evening. And that's sort of the mentality of it. It's a different mentality than you would use going to Woolies or Coles or even Aldi or Kaufland or any of those. But he knows that the quality he's getting is really, really good. And while they've only got 3,700 or so stock keeping units, the margins are incredibly low, sort of 11% margins compared to the average sort of 29 in the others and 50% in normal higher end retail. People know it's cheap and they've bought their own loyalty. So once they've paid that membership fee, it's like Prime in Amazon. Once you've paid that membership fee, there is a real desire to get your value for money out of it. So you go back and back. You'll even drive halfway across town to do it. I'm just going to now just explore a couple of them. I can't leave Facebook alone. I mean, it's been very topical over the last year, and I understand that, but that's what Hyperion is about. We top and tail stocks over time, and so when I say, gee, we really think Facebook is a real opportunity, how much we'd own in the portfolio actually changes things substantially. So I'm going to tell you a very quick story. So in January last year, Facebook was nearly 12, I think it was about 12% of the portfolio. The stock was sitting at about $215 a share, and at that point it was a little too expensive. Our process said, looking 5 years ahead, this stock is now looking a bit expensive, and so we sold it down to about 7.5% of the portfolio. In February, the Cambridge Analytica issue came up. We knew about that, so we said, all right, we understand that damage. The stock derated to $175 a share, and we bought a little bit back. And then over the course of the next few months, it rose again, and I think it got to about $230 a share, at which time we did exactly what we did before. We sold it down, because once ahead it got ahead of itself. And then in September, they announced that they're going to have to spend a lot more money to, in short, sort of get rid of the bad actors. And that looked like more of a long-term issue to us, and so we held off, and of course the price derated very quickly to about 170, and actually it continued to fall, and we held off, and then we started buying some stock around 135, 145, and of course the stock is back to, I'm not sure, at $172 today. So interestingly enough, between January and today, the stock has fallen from 215 to 170 around. And yet it's actually a positive attribution for our fund. And that's the importance of topping and tailing stocks and not falling in love with them, but being very realistic with them. So that's in spite of the fact that the numbers just keep going. So 2.7 billion people on a monthly basis access one of Facebook's products, whether it be WhatsApp, Messenger, Instagram, or Facebook, and 1.6 million on Facebook daily. Now, that's just a ridiculously large number of people. But the important point I want to make here is that there are simply tens and tens and tens of millions of small, medium enterprises that are on Facebook. They're sitting there, they have a website that affected because they can't afford to have their own website. They use Facebook as their website, and they're not advertising yet. Only 7 million of them are. And that's the opportunity, because the people are all looking at these new platforms. When I say new, I mean in the last 20 years. I'll give you an example. This is a percentage of US internet users who use YouTube as of January last year. I don't have this year's numbers yet. I don't know about you, but I was shocked when I saw these numbers. Let me just point them out to you. 96% for 18 to 24-year-olds. That sounds about right. My kids, 10 and 16, they watch nothing else than YouTube. Maybe an occasional Netflix of something, and maybe an occasional Prime of something, but 99% of their watching are really quite interesting shows on YouTube. Didn't this surprise you? 51% of the over 75s. 66% of the 65 to 75. Like the penetration, no wonder it's the biggest television station in the world. Now, advertising to TV has been amazingly resilient. When we talk to the buying agencies, we still can't work out why the hell a lot of these big businesses are still advertising on TV in spite of the fact that people aren't watching it anymore in the way that they did before. And we can only put it down to, it's like buy IBM, you'll never go wrong, except that doesn't apply anymore. But for years, you can't get fired for putting money into TV advertising because it just seemed like the right thing to do. And hey, this newfangled social media advertising doesn't seem to work. But if people really are watching this much of YouTube, for example, as the biggest television station, you'd think this is where the advertising would go. The rise of e-commerce. So last year, for the first time, over 10% of retail in the US was online. Actually, that actually understates it, because there are a bunch of categories that you probably would never buy online, like I don't know, gas, fuel for cars, auto parts. I mean, I guess we sat here for a while, we could think about them, but probably the number's closer to 20%, but there's still a lot of runway there. That sort of, I know it's not seasonally adjusted, that's why it looks like a shark biting, but the reality is e-commerce sales $450 billion, total retail sales $5 billion. It's what we look for, is a substantial addressable market, and clearly that rise of online, which is dominated by the Amazons of this world, are a fantastic long-term opportunity with plenty of runway left. Regulation. So I talked about the great fears for some of these businesses is poor execution as they get large. I mean, scale is not really their issue because they scale well, but they're running lots and lots of businesses. And so sort of execution is an issue, but also regulation is an issue. I don't know, cast your mind back a year or so, and when GDPR was introduced into Europe, and you all had to go onto Facebook out here and answer your privacy questions and say, I accept these new rules. The numbers I saw at the time were, well, they could lose 20% of their online users, of their active users. This is the number: 377 million down to 376 million. That's 0.26% of a drop. Now, all I can say is that, users of social media don't seem to value their privacy. And I'm not saying this is a good thing or a bad thing. I'm not trying not to make a moralistic view here. But the reality is that it's not really the issue that everybody thought of. And regulation would actually hurt the junior competitors much more than the leading competitors in this. So, we're watching for what regulation could do in all of these, but businesses like Facebook, for example, are spending lots of money on making sure they're not regulated. I mean, they've put 30,000 people on just focus on getting rid of the bad actors. They're not kidding, they've really got stuck in. So this is my last slide. Some of you may have seen it before, and it refers to our Australian equity strategy. So the green line is the earnings per share index of our Australian strategy over 22 years. The black line is the price of the portfolio, sort of ex-dividends. Now, clearly in the short term, you can see that the correlation between earnings and price in the short term is not very good over 1 year periods. But actually, once you get out over about 5 years, you get quite a good correlation between earnings and price. Here's the Australian market here. So the blue line is the earnings of the S&P ASX 300, and the red line is the price. I think the thing that jumps out to me when I look at this is, firstly, the earnings of the Australian market post-GFC never recovered. Now, it's earnings per share that didn't recover, and the reason why it didn't recover because there was massive equity issuance post-GFC, which diluted earnings, and then we've never really recovered. It's just gone sideways since, and that's been bad for your clients. Quality businesses that didn't have to go and raise a lot of money because they had so-called lazy balance sheets, have actually done pretty well through that period. These are the companies we've picked with real earnings growth, and the prices follow. The difference there, as Matt said at the beginning, is about 4% alpha over 22 years, and that's about the same as the difference between the earnings over that period. Why do I put this chart up? Well, I've got a similar one for global, but it's just too short to be meaningful. But I want you to know that that's what we're focusing on, and that is getting earnings roughly right. You can't get them right across every company. Roughly right across the whole portfolio is what's going to really make the difference to your clients over the next 10 to 20 years. And to do that properly, you've really got to be following those structural tailwinds and making sure you're getting the companies who are executing it right.